Tools of the Federal Reserve, Part 2. Open market operations are the Federal Reserve's primary tool for influencing the economy, and they work by changing the amount of money and liquidity in the financial system. At the most basic level, open market operations involve the Fed buying or selling government securities, like U.S. Treasury bonds. When the Fed buys securities, it injects money into the banking system. Banks now have more reserves, which increases their ability to lend. As lending rises, interest rates tend to fall, borrowing becomes cheaper, and businesses and consumers spend more. This stimulates economic growth. On the other hand, when the Fed sells securities, it pulls money out of the system. Bank reserves decline, lending slows, interest rates rise, and economic activity cools. This helps reduce inflationary pressure. Now, during periods of severe economic stress, like the 2008 financial crisis, the Fed expands this strategy through quantitative easing, or QE. Quantitative easing goes beyond routine operations. The Fed purchases large quantities of longer-term securities, including treasury bonds and mortgage-backed securities. This not only increases bank reserves, but also pushes down long-term interest rates, supporting investment, housing, and financial markets more broadly. In short, traditional open market operations manage short-term interest rates and liquidity, while quantitative easing targets long-term rates and broader financial conditions. Together, they allow the Federal Reserve to influence borrowing, spending, and ultimately the pace of the entire economy.